Has all the news about the unprecedented raising of interest rates by the Federal Reserve have you concerned? Does it seem like they're raising rates every day? How is that going to affect your plan to buy a house this year? Today, we're going to try to demystify the Federal Reserve and their interest rate market manipulations right now. We've all seen the average monthly mortgage rates rise since the end of 2021, and along with that, we've seen gas prices, food prices, and energy costs rise. The daily news is replete with predictions of a global recession and supply chain disasters. What we're going to go over today is a quick review of the Federal Reserve, and it's going to be a very simplified version. We're going to discuss what their stated goal in life is, what kinds of things they do to affect the economy, and how their actions affect the interest rate you pay on your mortgage and your home equity line. One caveat: although I majored in economics at BYU, it was a long time ago. As a matter of fact, when I was at BYU, the mountains were much smaller. However, I've had many clients call me regarding the almost weekly news out of the Federal Reserve, so I decided to update myself on the subject. The Federal Reserve. Let's do a quick history, very simplified. The Federal Reserve System is the central banking system of the United States and was created by Congress in the Federal Reserve Act and signed into law by Woodrow Wilson in 1913. The stated need for a central bank was promoted after a series of financial panics in the late 1800s, in particular the Panic of 1907. The Congress at that time established three key objectives for monetary policy in the Federal Reserve Act. The first was to maximize employment, the second was to stabilize prices, and the third objective was to moderate long-term interest rates. Of course, these three objectives have expanded over the years to include supervising and regulating banks, maintaining stability of the financial system, and providing financial services to depository entities such as the U.S. government and foreign institutions. Basically, the Federal Reserve System is composed of two main layers. First, there's the 12 regional Federal Reserve banks, and they regulate and oversee privately owned commercial banks, and they use tools such as lending to banks to cover short-term fund deficits, issuing banknotes for general circulation as currency, and conducting auctions and buybacks of federal debt. The second layer is the Federal Open Market Committee, and they set monetary policy, and their main tools is to buy and sell U.S. Treasury securities. The Open Market Committee sets monetary policy by specifying the short-term objectives for the Fed's open market operations, and that is to set the target level of the federal funds rate. We're going to hear more about that later. The federal funds rate is the rate that commercial banks charge each other for overnight loans. The Open Market Committee meets at least 4 times a year, and it is the results of those meetings that you've been reading about a lot in the news. Theoretically, the Federal Reserve is independent of Washington, D.C. and the politics of the day. However, history has shown that it's more interdependent with Washington, D.C. rather than independent. The New York Times had an interesting piece in October of 2017 that stated, "Congress depends on the Fed to steer the economy and to absorb the blame when the economy falters." We're seeing a lot of that. This statement from the New York Times helps explain why so many things happen during election year, and why there is often a tug-of-war between what the politicians want and what the Federal Reserve wants. And that contributes to the noise that we hear all the time, and the confusion many buyers have regarding what's going on with interest rates. Okay, so does the Federal Reserve change mortgage rates? Well, the answer is no. The Federal Reserve does not set consumer interest rates such as home mortgages. However, the Federal Reserve can change federal funds rates, which they've been doing a lot lately. And while mortgage rates and federal funds rates are not directly related, there is a ripple effect. Consumer mortgage rates, what you pay for your house, they have a long-term focus and are affected by long-term forecasts for the economy and future interest rates. The federal funds rate is very short-term, as it affects the overnight rate banks charge each other to move money between banks. Now, the Fed's goal in changing the federal funds rate is to manipulate the economy, be it to stimulate the economy, to hold the economy steady, or to slow down the economy to fight inflation. The important thing to remember is that consumer mortgage rates are not a tool to speed up or slow down the economy. They are for consumers who want to refinance or buy a home. So how do Federal Reserve actions influence mortgage rates? Well, believe it or not, what most affects mortgage interest rates is what the Fed says in their speeches. Let me repeat that. What most affects mortgage interest rates is what the Fed says in their speeches. 3 or 4 times a month, somebody from the Fed will publicly appear and give a speech on the threats of inflation, the growth of the economy, and any threats to the economy in general. Wall Street and many others will dissect these speeches and try to guess what the Fed plans to do in the future, as the Fed tries to manipulate the economy to meet their stability, employment, and low inflation goals. Ideally, the Fed wants the inflation rate to be about 2%. And for the last decade, that has been the approximate inflation rate. In the past year, however, the inflation rate has risen to over 8%, and that has the Fed worried. The tool the Fed uses to slow down inflation is increasing the federal funds rate, which they have done several times this year and plan to do a couple more times. Oddly enough, and this is kind of counterintuitive, this actually helps long-term mortgage interest rates because inflation is an enemy of long-term rates. And mortgages are long-term rates. That is because it increases the risk to banks. So what we've been seeing since late 2021 is that the banks have been raising long-term mortgage interest rates because they fear that inflation is going through the roof. As an example, in 1980, inflation was 13.5%, which is in part why we saw 30-year mortgage rates of 16%. My first home I bought in 1985, my mortgage interest rate was 11%. The net is that once the market believes that there's a plan to actually reduce inflation, then rates will come down. And that is what the Fed is trying to do today. Okay, let's look at the pluses and minuses of the Fed's strategy and what it means for you, the home buyer. Because the Fed is fighting inflation by raising federal funds rates, long-term mortgages should stabilize and even decrease over time if the Fed is successful. However, there's a time lag, obviously, and there's a lot of noise in an election year. Obviously, the Fed doesn't want to raise the Fed funds rates too much, as it could cause the economy to retract and go into recession, which is something that Congress never wants to see. The bad news for consumers with the Fed strategy is that the federal funds rate and the prime rate are tied together, unlike mortgages. Typically, the prime rate is about 3% higher than the federal funds rate. So if the federal funds rate is 3%, then the prime rate will be about 6%. You are most affected by the prime rate if you have a home equity line of credit, an auto loan, a personal loan, or credit cards, because most of these loans are directly tied to the prime rate. Maybe something like prime rate plus 0.25%. Here are 5 tips in buying a home and getting a loan in this market. Number 1, talk to your lender about the types of loans that you qualify for. Pick the best loan at the lowest risk. Number 2, do you want a fixed rate or an adjustable rate? A fixed rate will be safer than an adjustable rate, which is tied to the prime rate, if the prime is increasing, but your payment may be higher. Number 3, also remember that home prices average about a 10% increase per year. Discuss this with your lender as to whether those increases will offset any interest rate increase if you wait. Number 4, inflation may cause HOAs to raise their prices to cover the cost of maintenance improvements. Keep that in mind when you're shopping for a house. And number 5, lender underwriters may start to look at credit card debt and other prime rate tied loans with less favor than they have in the past, because there's a higher risk if the prime is going up and up and up. Mortgage rates have increased in the last year, but in reality, they're about the same rate as they have been for a long time, in that 4 to 6% range. So there's nothing to panic about. Find the right house and get the best mortgage you can, because historically you should be able to refinance at some future point to lower the rate. It could be 3 years, it could be 5 years, it could be 2 years, you never know. All right, well, thank you, everybody. I appreciate you listening. Be sure to check out my videos on qualifying for a loan and buying your first home. Thanks a lot. Have a great day. See ya.